There is one skill that separates traders who consistently know where price is going from traders who are always guessing. Not a strategy, not an indicator, not a pattern, a skill. The ability to read market structure. Because market structure is not a concept you apply to a chart after you analyze it. Market structure is the chart. It is the fundamental language that price speaks in. Every trend, every reversal, every consolidation, every breakout in the history of every financial market is built from the same two building blocks: swing highs and swing lows. And the relationship between consecutive swing highs and swing lows tells you everything you need to know about who is in control, where price is likely going next, and when that changes. This video teaches you to read that language fluently. Video 7 of the complete trading series. Let's get into it. Before we go into the mechanics of market structure, I want to reframe what you are looking at when you see a chart. In video 6, we established that every candle is a battle report. Market orders versus limit orders, aggression versus patience, and the outcome of each battle determines where price goes next. Market structure is the accumulated result of hundreds of those battles. It is the map that forms when you zoom out from individual candles and look at the pattern of swing points they create over time. When buyers win more battles than sellers, price makes higher highs and higher lows. When sellers win more battles, price makes lower highs and lower lows. And when one side is decisively winning, each new swing point confirms their dominance. Each new swing point is evidence. And a trader who can read that evidence in real time, rather than reacting to individual candles in isolation, has a structural understanding of the market that most retail traders never develop. The 4 elements of market structure. Market structure has 4 building blocks: the swing high, the swing low, the higher high or lower high, and the higher low or lower low. Understanding each one is essential before we talk about how they combine. A swing high is a price point where price moved up, reached a peak, and then moved back down. The candle at the peak had a lower high on both sides. Price went higher, then rejected, and went lower. A clean swing high has at least 2 lower highs on each side. The more candles on each side that are lower, the more significant the swing high. A swing high is significant because it represents a level where sellers overwhelmed buyers. Price reached that point, and sellers stepped in with enough force to reverse the move. That level is now marked. It is evidence that sellers are active there. A swing low is the opposite. A price point where price moved down, reached a trough, and then moved back up. The candle at the trough had a higher low on both sides. Price went lower, then buyers stepped in and pushed it higher. A swing low represents a level where buyers overwhelmed sellers. Price reached that point, and buyers defended it with enough force to reverse the move. That level is now marked, evidence that buyers are active there. Now here is where the structure begins. When you connect consecutive swing highs and swing lows, you can see whether the overall sequence of peaks and troughs is moving up, moving down, or moving sideways. And that sequence is market structure, bullish market structure, higher highs and higher lows. When each new swing high is higher than the previous swing high and each new swing low is higher than the previous swing low, the market is in bullish structure. This is the textbook definition. But let's understand why it happens mechanically. Each higher high means buyers pushed price to a new peak. They had enough conviction and enough order flow to surpass the previous peak where sellers once won. The previous swing high, which was once a point of seller control, has now been exceeded. The sellers who defended that level before were not strong enough this time. And each higher low means that when sellers pushed price back down from the new high, they could not push it as far as before. The buyers stepped in sooner, at a higher level. This is the mechanical fingerprint of increasing buyer dominance. Each swing shows buyers winning more and sellers winning less. The structure is bullish. The directional bias for any trade should be to look for long opportunities, not short bearish market structure, lower highs and lower lows. The opposite is equally straightforward. When each new swing high is lower than the previous swing high, and each new swing low is lower than the previous swing low, the market is in bearish structure. Each lower low means sellers pushed price to a new trough, exceeding the previous low. The buyers who defended the previous swing low were overwhelmed. And each lower high means that when buyers tried to push price back up, they could not reach the previous high. Sellers stepped in sooner, at a lower level. The directional bias in bearish structure is short. Looking for long entries against a clear bearish structure is one of the most common and costly mistakes in retail trading. Structure tells you the flow. Trade with the flow. The break of structure. Trend continuation confirmed. The break of structure is the most important event in a trending market. It is the moment when price confirms that the trend is continuing. In a bullish market, a break of structure occurs when price breaks above the most recent swing high with a candle close above it. This confirmation matters. A wick above a swing high is not a break of structure. The candle must close above it. The close is the final verdict. As we learned in video 4, the close represents who won the negotiation. A close above the previous swing high means buyers won the negotiation at that level decisively. The structure continues upward. In a bearish market, a break of structure occurs when price closes below the most recent swing low. Each break of structure in the direction of the trend is confirmation that the dominant side is still in control. It is evidence, not prediction. Every successful trend on every chart in every market is built from a sequence of breaks of structure in one direction, the change of character, where the trend actually dies. If the break of structure is the confirmation of trend continuation, the change of character is the first warning that the trend is ending. And most retail traders miss it completely because they are not watching for it. A change of character in a bullish trend occurs when price breaks below the most recent swing low. Not a swing low from long ago. The most recent one. The one that was formed as part of the most recent higher low. When price closes below that level, it has broken the sequence of higher lows that defined the bullish structure. The market has just shown you that sellers pushed price lower than the most recent level where buyers were dominant. This is not a guarantee of reversal. It is the first structural evidence that the bullish dominance is weakening. A single change of character in a strong trend is a warning. Multiple changes of character in sequence are a trend reversal confirmed. Here is the distinction that most traders miss. A break of structure is a continuation signal. A change of character is a potential reversal signal. They look similar, but they are completely different events because they break different swing points. A break of structure breaks a swing high in a bullish trend. A change of character breaks a swing low. When you learn to see which type of break is happening in real time, you gain the ability to distinguish between a trend that is continuing and a trend that is dying. Internal structure versus external structure. This is the most advanced concept in this video, and it is the one that will give you the most edge once you understand it. Every trend contains two levels of structure simultaneously. The external structure is the higher time frame view, the sequence of major swing highs and swing lows that define the overall trend. The internal structure is the lower time frame view, the smaller sequence of swing points that make up each leg of the external structure. Understanding the relationship between the two is what separates traders who enter at optimal points from traders who chase moves that are already over. Here is how it works in practice. On the daily chart, price is making higher highs and higher lows. Clear bullish external structure. Each upward leg from a daily swing low to the next daily swing high is made up of multiple smaller internal swing points on the 4-hour chart. These internal swing points form their own smaller structure within each leg. When the daily chart shows a pullback from a new high to a new higher low, the 4-hour chart shows the pullback as a series of internal lower highs and lower lows, a small internal bearish structure within an overall bullish external structure. And when the 4-hour internal structure shifts from bearish back to bullish, showing a break of its own lower high, that is the signal that the daily pullback is ending and the daily trend is about to continue. You entered at the beginning of the continuation, not in the middle of it. This is top-down structural analysis. The external structure tells you the direction. The internal structure tells you when to enter in that direction, and the relationship between the two gives you the highest probability entry points in any market. Reading market structure in real time. Now let's put it all together into a practical process for reading market structure in real time on any chart. The first step is to identify the most significant swing highs and swing lows on the higher time frame. These are the anchors of your structural analysis. You are looking for swing points with multiple candles on each side confirming the peak or trough. Not every small candle reversal. Significant swing points that represent real battles where one side clearly won. The second step is to connect those swing points sequentially and ask the question, is each new swing high higher or lower than the previous one? Is each new swing low higher or lower than the previous one? That answer gives you the structure. The third step is to watch the most recent swing point, because the most recent swing point is the one that matters most for current analysis. A break of the most recent swing high in a bullish trend confirms continuation. A break of the most recent swing low is the change of character you watch for. The fourth step is to drop to the internal time frame and watch for the internal structure to confirm the direction of your entry. Wait for the internal structure to show a break in the direction of the external trend before entering. Do not enter during an internal pullback against the trend. Enter when the internal structure shows the trend is resuming. Here is the mindset shift that this concept requires. Stop looking at every candle as a potential trade. Start looking at candles as data points that build toward a structural picture. A single candle means very little. A pattern of swing highs and swing lows that forms over many candles means everything. The structure is the context that gives every individual candle its meaning. A bullish engulfing candle in the middle of bearish structure is noise. The same bullish engulfing candle at a higher low within bullish structure, after a change of character in the internal bearish structure, is a high probability entry with full structural context behind it. Same candle. Completely different meaning. Because structure is everything. The market is always in one of three states: trending up, trending down, or ranging. Bullish structure is trending up. Bearish structure is trending down. When structure is neither clearly bullish nor clearly bearish, when swing highs and swing lows are overlapping without a clear directional bias, the market is ranging. And ranging markets require a completely different approach, which we will cover in detail in a later video. For now, the most important skill is identifying which of these three states the market is in and having the discipline to only take trades in the direction of the current structure. Drop a comment. Looking at the charts you normally trade, can you now identify whether the market is in bullish structure, bearish structure, or ranging? I read every single one. See you in the next video. Stay disciplined.